morning, and welcome to the press briefing of the Global Financial Stability Report. I am Randan Naggar of the IMF's Communications Department. Let me start by introducing our panelists here. We have with us here from the Monetary and Capital Markets Department, Tobias Adrians, Financial Counselor and Director, Fabio Natalucci, Deputy Director, and Evan Papageorgiou, Deputy Division Chief. Tobias will give some opening remarks, and then we will take your questions through Media Briefing Center and on Webex. Tobias, please go ahead.
Good morning, ladies and gentlemen. Thank you for joining us as we launch the new edition of this year's Global Financial Stability Report. The global economy is beginning to emerge from the economic shock caused by the COVID-19 virus. The economy has benefited from extraordinary policy measures that have eased financial conditions, preventing a deeper economic downturn. But those actions may have unintended consequences. Valuations for risk assets have become stretched. Financial vulnerabilities have intensified. Continuing policy support remains necessary, but a range of policy measures are needed to address vulnerabilities and to protect economic recovery. We see three priorities. First, addressing corporate sector vulnerabilities and repairing balance sheets is a priority. Second, tightening some macroprudential tools in advanced economies is important to safeguard financial stability and to enhance supervision and regulation of non-bank financial institutions. Third, rebuilding buffers in emerging markets is a policy priority to prepare for a potential repricing of risk and the reversal of capital flows. Central bankers have proven to be highly skillful during this past year as they successfully engineered a financial rescue. In the year ahead, their creativity is likely to be severely tested again as they confront the challenge of guiding their economies through asynchronous recoveries, stretched market valuations, and strained social divisions.
Much, Tobias. There is a question that's on everyone's mind on emerging markets, which you have just mentioned. One thing is that what if the US hikes rates, and what is the effect going to be on emerging markets?
Indeed, global markets are nervously watching the current moves in interest rates. Since the summer, yields on the 10-year US Treasury note have more than tripled and are now back to their pre-pandemic level. The good news is that the interest rate increase has been spurred by strengthening growth and improving vaccination prospects. The bad news is that the increase also reflects uncertainty about the future path of Treasury supply and central bank asset purchases, as reflected by term premia, which have risen sharply. Both nominal interest rates and real interest rates have risen. But nominal yields have risen more, suggesting market-implied inflation is recovering, an intended consequence of easy monetary policy. For the moment, global rates remain low by historical standards, yet the speed of adjustment in rates could generate unwelcome volatility in global financial markets. It could potentially trigger a tightening of global financial conditions and potentially trigger a sudden return of risk-off sentiment. Thus far, overall financial conditions remain accommodative. That is good news, and policymakers must continue to promote those easy conditions until the strength of the recovery is ensured. By contrast, in countries where the recovery is slower and where vaccinations are lagging, policymakers may be forced to lean against unwarranted tightening. The recovery is thus expected to be asynchronous, with a stark divergence between advanced economies on the one hand and emerging market and developing economies on the other hand. Given their large external financing needs and their slow progress on vaccinations, emerging markets are likely to face daunting challenges. Earlier this year, international investor flows into emerging market debt had a sudden reversal for several weeks, a change not witnessed since last summer. Moreover, the recent rise in US real yields has also spilled over to funding costs in emerging markets. With a sizable financing needs this year, emerging markets are exposed to rollover risk, which will be complicated further if domestic inflation rises or if global long-term interest rates continue to rise. For many frontier market economies, market access remains impaired.
Thank you, Tobias. Let me follow up on one other thing, please. The pandemic has taken a toll on businesses across a variety of sectors, with all the strains placed on the corporate sector. Can you please give us a bit of an overview about the corporate sector and how it is affected by this pandemic and the financial stability at this point?
Yes, in many countries, the corporate sector is emerging from the pandemic over-indebted, although with notable differences across firm size and economic sectors. To aid policymakers recalibrate the support to the corporate sector, this GFSR presents a decision tree to assess whether firms should rely on market finance, should seek government support, should be restructured, or should be liquidated. Whether the economic recovery will be uneven and whether it will suffer from scarring effects will depend on the ability and willingness of banks to lend once support is unwound by the governments. Concerns about the credit quality of hard-hit borrowers and about the profitability outlook are likely to weigh on the risk appetite of banks. Even if most banks have ample capital buffers, only a few may be willing to use their buffers to lend and support the recovery.
Thank you, Tobias. And now we're going to go take your questions from OMBC and Webex. I'm going to start with the Online Media Briefing Center. And since emerging markets has been the topic today, Tobias, we have a question and the team from from Xinhua. Given the large external financing needs and rising US interest rates and potential capital outflows, which you have mentioned, Tobias, what's your take on the possibility of emerging markets financial crisis? Does the IMF have enough resources to provide liquidity support for emerging markets and developing countries?
Thank you so much for this important question. Let me start by answering and then also turn to my colleagues. So we have indeed seen a sharp rise in interest rates globally, and advanced economies are oftentimes able to insulate themselves from this rise in yields globally. But emerging markets are not always capable to insulate their economies from the rise in yields. And so some emerging markets have indeed seen a rise in their funding costs. However, by historical standards, yields are still fairly low and global financial conditions do remain easy. But of course, there is continued uncertainty about the outlook ahead. One is about the recovery of advanced economies that might put upward pressure. The other one is about setbacks in some emerging markets. So we could certainly see some volatility in financial conditions and in capital flows associated with the realization of uncertainty. The IMF has a large balance sheet and has large financing capacities to assist our membership. To date, we have provided rapid financing to a very, very large number of countries. This is the largest and broadest rapid financing rollout that we have ever done at the IMF. And we stand ready with additional financing to any members who need it. Let me turn to Fabio and Evan to see whether they want to complement my thinking around this.
Thank you, Tobias. Perhaps I could add as well here that along with the IMF, the international community has also helped a lot. We applauded the efforts of the G20 to extend the debt service suspension initiative to the end to June 30th of this year. And we have recommended for this extension to be moved down even further, perhaps to the end of this year. In addition, the G20 has put forward the guidelines for the common framework for debt treatments beyond the DSSI. As it is right now, it covers the same sample of countries in a relatively more limited fashion for the DSSI eligible countries. But as we say in the report, we think that the common framework being able to apply to a broader set of countries may also be a way forward.
Thank you. Anything to add, Fabio? Okay, let me stay on the topic here of emerging markets, and a question from Okech Martin Luther from Uganda, Monitor Publication. He's asking about the assessment of the capital markets in sub-Saharan African countries, and also about the monetary policy in the same region, sub-Saharan Africa. So we start with Tobias and then follow up. Thank you.
Yes, thank you. So sub-Saharan Africa has been hit by this pandemic, just like every other countries. Every country in our membership has been hit by the pandemic. However, the numbers coming out of Southern Africa in terms of the pandemic have been somewhat lower than in other countries. So that's good news. There has been some resurgence in infections recently, and we do hope that the medical situation will get under control. But of course, there are two major challenges. One is that the economic headwinds from the global economy have hit sub-Saharan Africa hard, and countries have been depressed, even though the medical conditions might have been less severe than elsewhere. So the economic headwinds are strong. And secondly, many of the sub-Saharan African countries have not been able to provide as much fiscal support as advanced economies or emerging markets. So on average, in 2020, advanced economies have provided 15% of fiscal support to their companies and their households. In emerging markets, the number was about half of that, 7 to 8%. But in sub-Saharan Africa, it's only between 1 and 2% of fiscal support. And so when we look forward, we see that the recovery is going to be slower in sub-Saharan Africa compared to emerging markets or advanced economies. And so that means that there's an asynchronous recovery that could put financial stability at risk. Of course, we have started a number of new programs, and we are very actively engaged with governments in the region in order to make sure that we help in any way we can.
Thank you, Tobias.
Perhaps I could add something to Tobias's point here. Monetary policy stance in sub-Saharan Africa, as well as the rest of the world, emerging markets overall as well, has been accommodative for the regions that Tobias mentioned, and it's expected to remain so for the foreseeable future in order to accommodate more policy support. Uganda, that you mentioned, the policy rate has been lowered to 7%. Still has positive real policy rates, so there's still quite a lot of accommodation in the system, and that's expected to continue. In terms of the capital markets, obviously, much like the rest of the world, sub-Saharan African spreads had widened a lot during the top of the pandemic. They have recovered somewhat, but they still remain above pre-pandemic levels. And we are heartened by the fact that recently we have seen some hard currency bond issuance as well coming out of the region after a long pause, and we expect this to continue. We hope this will continue.
Okay, we move now to our Webex viewers here, watchers. We'll start with Dua Abdelmenem. Dua, you have a question, Ahram Online? This also goes into emerging markets questions. We can't hear you, Dua.
Can you hear me now?
Yes.
Okay, thank you, Randa. Thank you, Tobias, for taking my question. My question is for Tobias. The report estimates that liquidity stress is high at small firms in most sectors and across countries, while solvency stress is high at small firms, but also notable at medium-sized and even large firms in the most affected sectors. So what are the required procedures to deal with such serious situation in emerging markets and developing countries, including countries like Egypt? Thank you so much.
Thank you for this question. And the corporate sector is going to be a policy priority for our membership going forward, including emerging markets such as Egypt. So what we are seeing is that in countries where the recovery is taking longer to realize, the stress on the corporate sector is higher. And that is particularly so in contact intensive industries. Um, tourism, of course, has been hit extremely hard, but also entertainment, restaurants are particularly adversely impacted by this crisis. We do hope that governments are able to bridge to the recovery, and we provide a kind of policy framework to assess which companies should get additional support in terms of equity or should have a restructuring of their liabilities. But of course, there are some companies that do need to be resolved as well. So these are key priorities. And the evolution in the corporate sector, of course, importantly impacts the health of the banking sector as well. And so having a very timely, holistic view that is data sensitive and is collecting all of the necessary information for further policy steps is key. So to the extent that countries can provide further fiscal support, that would certainly be helpful in order to bridge to the recovery and get economies back on track, including in the corporate sector.
Thank you, Tobias.
So maybe I can add one couple of points to Tobias. So some of this liquidity risk and solvency risk cut across different dimensions. So across different firm size, across regions, and across some of the sector. Right? Some sector has been hit harder than others. One important difference between advanced economies and emerging markets is that firms in advanced economies may have access to capital market. So, and this has been one of the positive of the unprecedented policy support in terms of monetary policy, fiscal policy, financial policies. The capital markets have reopened, and larger advanced economies benefit more than emerging markets from access to global capital markets, particularly big for large firms. So smaller firms, SMEs, have a harder time accessing capital markets. They're more bank reliant, and often their business model is oriented towards sectors that are more intensive, contact intensive. So for emerging markets, the important is that the targeted fiscal measure, particularly to address both liquidity risk, for example, through loan guarantees, or solvency risk to equity-like injection, as Tobias has mentioned. And the other important point for emerging markets is also enhance resolution regimes so that some of these issues can be addressed out of court in a quicker and more efficient way.
Thank you, Fabio. Now we continue on Webex. We'll take a question from Sai-Chin now. So please go ahead.
Hello, can you hear me?
Yes, we can hear you.
Thank you very much. My question is, according to the report, China has recovered more rapidly than other countries, but at the cost of a further build-up in vulnerabilities, particularly risky corporate debt. So what would be your suggestion to tackle this problem? Thank you very much.
Thank you.
Yeah, so let me start and then pass on to my colleagues as well. So China, of course, has re-emerged from the crisis more quickly than any other country in the world. The measures that were taken to contain the pandemic were very quick and very effective. And as a result, the Chinese economy recovered to pre-crisis levels already last year in 2020. And so that places China in a very good situation. But as you point out correctly, there were measures that were deployed that did lead to further increase in leverage and in certain vulnerabilities. There, of course, in China, there have been pre-existing vulnerabilities already prior to the pandemic, such as certain weaknesses in small and provincial banks, as well as leverage in some segments of the corporate sector. And so having a policy approach that is addressing those vulnerabilities and is balancing wanting to stimulate the economy on the one hand, but doing it in a way that is safe on the other hand, and so is getting the intertemporal trade-offs in between easy policy and the medium term buildup of vulnerabilities, getting this balance in the policy mix right is very much first order.
Perhaps I could add as well to the points that Tobias made that it is also very important to unwind the implicit guarantees that are embedded in the system. It is a very delicate act, but an urgent one in order to achieve financial stability. Issues relating to perhaps guarantees that are taken by investors as having a support by either the local or some other sort of government create an artificial or perhaps compress spreads unduly that have very little relation to fundamentals for the particular debtor. And that has to be resolved in order to have a sustainable and sustainable recovery and also a long-term financial stability.
Thank you so much. We're going to go still on Webex. We'll take a question from Ikai, and then we're going to go on OMBC and revert to Webex. We have a lot of questions today. So we'll take now from Ikai from Webex. Please, go ahead.
Hello?
Yes.
Thank you. So I got two questions. One is from skyrocketing Bitcoin to GameStop price turmoil to the recent Archegos. So how would you evaluate the increasing risk and the market volatilities? To what extent is it related to the U.S. unprecedented stimulus package? And also, how would be the spillover effects to emerging markets down the road, including China? Thank you.
Thanks. That's a very relevant question. So monetary policy has been easy in most economies around the world, and above all, in some of the major central banks, such as the U.S. Federal Reserve, the European Central Bank, and the Bank of Japan. So easy financial conditions is an intended consequence of the monetary policy accommodation. Easy financial conditions means that companies can borrow, can issue debt, and can issue equity. And indeed, we do see a boom in the IPO markets through special purpose acquisition vehicles. This is, to some extent, the intended outcome of policies. But of course, we don't want risk-taking to be excessive. So again, there's a question about the balance of wanting to stimulate credit supply and the restart of the economy while making sure that it's safe. And we do see valuations that are stretched in some segments. Of course, the run-up in the valuations of Bitcoins has been spectacular this year, and there's certainly uncertainty about future valuations that are very relevant. We also see some stretching in some segments of the technology sector around the world, which could be leading to volatility going forward. But having said that, of course, economies are recovering. So on the one hand, you have like a tug of war in between the recovering economies, the easy monetary policy, and then valuations that might be stretched. So exactly how it's going to play out, we don't know, but there's certainly a possibility of further volatility. In terms of emerging market flows, I would distinguish in between flows to China China, of course, is the largest emerging market in the world, and other emerging markets. A lot of the flows to China that have been very large by historical standards have to do with structural changes in global capital markets. Um, both stocks and bonds of Chinese issuers are now included in the benchmark indices globally, and so investors are allocating capital that is likely to stay. But of course, there are other capital flows that are more fickle and that could be subject to bursts in global risk appetite. Now, financial conditions do remain easy globally. And when we talk to investors, uh, they are continuing to be bullish about emerging markets as an asset class. So I think the baseline outlook is one of continued flows of capital. But of course, there are risks around that baseline.
Yeah, so maybe I can add a couple of thoughts to Tobias' point. So I think some of these episodes that you mentioned, right, whether this is the GameStop and the level retail investor, whether this is the special purpose acquisition companies, or whether this is the Archegos episode that we have witnessed, in some sense can be thought of as manifestation of some excess at the late financial cycle. Now, per se, those are not necessarily systemic. We have seen perhaps imposing some losses on some banks, but those are not large number that we would, at this point, given what we know, deemed as systemic. It does, though, raise an issue which we have highlighted in the past financial stability report several times, which is the connection between elevated vulnerabilities and elevated stretch valuation, right? And this is that when there is an overlap between the two, so there is a elevated valuation that gets unwound and then interact essentially with elevated vulnerabilities, in this case, financial leverage. That's when I think it gets more concerning from a financial stability perspective, right? And this is even more pernicious when this interaction between stretch valuation and elevated vulnerabilities occur in the non-bank financial intermediation sector, right? In this case, involve, for example, some family offices and hedge funds, because that's where we have less visibility, where we have fewer data, where it's more difficult for policymakers to assess risk at that point. In addition to that, even more concerning when there is still interconnection with the traditional banking sector. And that was the prime brokerage providing leverage to this hedge fund. So it's the connection essentially between vulnerabilities, stretch valuation occurring in the non-bank financial intermediation, and particularly when there are still connections with the banking sector. I think that calls for raise some question, for example, whether the assessment framework, monitoring framework we have is actually able to assess and catch in time this episode. Also, whether we have enough data, for example, to track and monitor these vulnerabilities, whether disclosure regime in place now are appropriate or need to be expanded, and more generally, whether the regulatory perimeter around the non-bank financial intermediation should be expanded or not, and whether we have the tools. And so toward this goal, the IMF is working with the Financial Stability Board. Look back at the March 2020 turmoil that involved some of these non-bank financial intermediaries, trying to come up and assess whether the framework, again, and the tools are appropriate or more work is needed.
Thank you, Fabio. You spoke about turmoil and tantrums, so let me move to Greg Robb's question here from Market Watch. Greg is asking about some former policymakers in the US noting that if the Fed tightens suddenly, there's going to be a tantrum there. So can you please give us your views on this, team?
Yes, thank you. Thank you for this important question. The way I look at monetary policy today, and this question was specific to the US, is that there are two main tools. One is the short-term interest rate, the federal funds rate, and forward guidance around the federal funds rate. And the FOMC has been very clear that it expects the federal funds rate to be very low for an extended period of time. The second tool are the asset purchases. And of course, we have seen historically large amounts of asset purchases last year that has cushioned the financial markets and has eased financial conditions, so that despite being in a global pandemic with an economic contraction as sharp as we have not seen in 100 years, still financial conditions were easy. That is a tremendous success of policymaking, of central banks around the world, and of the Federal Reserve in particular. Going forward, there's also a question about these asset purchases. So what is going to be the path of asset purchases? And of course, that's in a context where treasury supply is going to increase as fiscal policy continues to remain accommodative. So there's some uncertainty about the supply of, or the net supply of treasuries. So what is issued net of what is being bought by the central bank. So how much net supply is that? And this uncertainty is visible in markets. So market implied interest rate volatility has been rising. And in line with this rise in market implied interest rate volatility, the treasury term premium has also been rising. So the term premium is the compensation that investors in longer term treasury securities earn for taking on interest rate risk. And so this rise in the term premium and applied interest rate volatility really is a reflection of the uncertainty of the net supply of treasuries. Um, so, how this is going to play out is an important challenge for monetary policymakers in the US in particular, but also in other countries. And forward guidance really has to include not just the overnight federal funds rate, but also the future path of asset purchases. A very important backdrop, of course, is the change in the monetary policy framework that the Federal Reserve announced last August in Jackson Hole. So the Fed now aims to have a temporary inflation overshooting as it reemerges from the crisis. As you know, PCE inflation, core PCE inflation, which is the target in US monetary policy, has been below the 2% level that the Fed is trying to achieve. And so the expectation is that there will be a temporary overshooting. This is what is called the average inflation targeting framework. The forward guidance about the Fed funds rate, but also about the asset purchases, are really aiming to get at this temporary overshoot of inflation.
Tobias?
Perhaps I can come in here as well. I can't help but mention emerging markets every time taper tantrum is mentioned. As we say in the report, a persistent and sudden increase in U.S. rates could have a strong impact on emerging markets as well. The analysis we have done in the report shows that a 1 percentage point increase in U.S. term premia can have up to 1 percentage point increase as well for emerging market term premia if these are associated as well with an increase in inflation expectations, as has been the case for some emerging markets in recent weeks. And that can have destabilizing effects. And so that's one other spillover, if you will, to emerging markets that authorities should guard against.
Thank you, Evan. We're gonna still continue on central banking here, and we have a question from Daniel in Central Banking Publications. What factors could cause a natural rise in interest rates, and would this be a problem or a lesson for central banks? How can they handle it?
Yeah, so let me give a quick answer and then pass it to Fabio as well. So as I explained in the previous question, interest rates have two components. One is the expectation of the future path of short-term interest rate, and that is being controlled by forward guidance. And the other component is the risk premium or term premium that is embedded in longer term yields, and that is the compensation for investors to hold long-term interest rate risk. And that term premium, in some sense, is controlled via asset purchases and forward guidance around asset purchases. But of course, it's very importantly impacted as well by treasury supply, which is expected to change. The policy framework really has to aim at those two components. And the spillovers can be decomposed into those two components as well. So this year, we really have seen a rapid rise in the term premium that has spilled over into other countries. Um, and the forward path of the Fed funds rate continues to be very shallow. So expectations, market implied expectations for the future overnight rates are close to zero through the end of 2022 and actually into 2023. So many years at the zero low bound. Um, and as the economy is recovering and inflation is coming back, of course, there will be a reassessment of policy. Policy is always conditional on what is happening in the economy, and that could lead to further adjustments in expectations.
Yeah, maybe one couple of points to add. There is something healthy in interest rate moving higher because of like good economic performance, right? So to the extent that higher interest rates reflect a stronger rebound economic activity in the U.S. and improved in the outlook for the global economy, and also higher inflation. And so central banks have been trying for years to make up for past misses of inflation objectives. So that allows them to achieve the mandated objective in coming years. So I would start with the positives. There are other positive effects, for example, that remove some of the pressure on bank profitability because the yield curve steepens, for example, and also more generally, the incentive that we have seen in the non-bank financial institution sector to reach for yield when rates were very low. So some of this incentive and pressure may be relieved as rates move higher. So that's the positive. I think the concern is when we see rapid and persisting increase in interest rates. So very sharp increase over a narrow window. That's where one of the concerns, for example, when we saw the real rates move higher in the US, they were concerned about asset valuation, particularly equity valuation. And that's the gap between some of the returns of holding equity vis-a-vis interest rate was narrowing. So it is the persistent rapid rise in interest rate that raised question about the ability of this financial system to absorb over such a narrow window. But it is the positive of it reflects an improved outlook and inflation moving higher toward the inflation objective. I think we should welcome that development.
Thank you very much. We're going to go to Webex now again. We start with Lalit Jha from PTI. He has a question. Lalit?
Hi, thank you for doing this. I wanted to ask you about IMF's stand on cryptocurrency. Should it be banned or should it be allowed in some format? And also, what is your view on IMF on a government-controlled digital currency like digital rupee?
Yeah, thanks very much for the question about this very important policy priority of the moment. So we are in a technology revolution in the financial sector, and I would frame the debate in just pointing out that technologies will be able to be used for payments and for lending operations in ways that we might not yet be able to envision. So we have seen technologies impact, in particular in the cryptocurrency space for the moment. So cryptocurrencies such as Bitcoin didn't exist 10 years ago, and now they are very visible, and more investors are investing into Bitcoins and other cryptocurrencies. But it is important to keep in mind that the technologies, DLT, distributed ledger technology, and blockchains, those technologies can be applied in other domains as well. For example, we have seen stablecoins emerge. We have seen some of the technologies being used for clearing in securities markets. And more generally, the operations of the financial system can be greatly improved and be more effective by using new technologies. So that, I think, is the opportunity. And policymakers are very focused on making sure that all countries and the population at large will really benefit from these technological improvements. But of course, there are risks as well. And so policies always have to, balance taking advantage of opportunities with minimizing risks. And some of the risks are visible today in cryptocurrencies. For example, valuations are stretched in some of the cryptocurrencies, so investors could be exposed to a further rise or a fall in valuations. Secondly, there are concerns about the integrity of some of these means of payments and investment vehicles. So, integrity here refers to the overall ability of law enforcement and of governments to make sure that payment flows and capital flows are used for legitimate legal manners. And so that is another policy priority. So taking advantage of technologies to make access more broad, to have financial inclusion for everybody, but also to make sure that new forms of payments and new forms of investment are used for legitimate purposes. So that's what financial integrity means. So there are multiple policy objectives. Last year, the G20 released an important report that is laying out the way in which international financial institutions, together with the central banks around the world, are working together to enhance the cross-border payment system. The IMF is working alongside the BIS, the Basel for International Settlement, and the FSB, the Financial Stability Board, as well as the central banks around the world, to really improve global cross-border payments, to make sure that they are cheap, accessible, and safe.
Any follow-up? Okay, we'll take a couple more on Webex, and then we're going to take one on OMBC. So please go ahead, Roberto Vozzi from ASCA News Agency.
Yes, can you hear me?
Yes.
Can you hear me? Thank you for taking my question. So I would like to ask a question about one of the elements that you have outlined in your report about the strong increase of market assets related to ESG standards. I would like to ask if you think that this could be eventually a bubble, or if you think that it is a structural change in the market, and so this asset will continue to grow even in future. Also, when eventually some measures of stimulus from the public policy will have to be withdrawn. Thank you.
Yeah, thank you. And let me start and then pass to both Fabio and Evan, who are real experts in this field. So I think there is a shift in sentiment around ESG. ESG stands for environmental, social, and governance investment. And the population at large is more and more aware of the risks in terms of climate, of the costs of having poor governance, and of having social conflicts. So there is a reallocation that is very broad across institutions, including individual investors, pension funds, insurance companies, as well as mutual funds and other investment vehicles. And I think the first order trigger for that is the change in awareness, the change in investor preference. Secondly, the policy framework around ESG is changing, and it's continuing to be improved. And let me turn to Fabio, who is very actively working on the policy side in this segment.
Yeah, so I think one way to think about it, just step back for a second and think about what is the right architecture that we need to have around sustainable finance to make sure that they become an important engine to support a greener recovery, right? So it's a chain of things that we need. We start with data. we need robust, we need consistency, we need high quality data. They need to be more granular, they need to be more forward looking. And there's a number of initiatives both in the public and private sector to foster better high quality data. Then we need also a taxonomy. There are a number of taxonomy around the world. Does it mean at some point there will be a need to have some sort of minimal globally accepted taxonomy so that we can use the same language when both from the policy making side as well as from the private sector, they will use the same definition. That would make the pricing of climate risk, the assessment of financial stability clearly easier, both for, again, for the policy public sector as well as for the investor side. We also need a convergent toward frameworks, climate-related sustainability framework, and then we need the last step in this architecture. It's a link between sustainability standard as well as a link to financial variables. That's what it really in the end matters for investors. And it's in this chain and this architecture with a chain of data that goes from the borrowers, so the corporates, the household, to the lender, whether those are banks or non-banks, all the way to the investor. So I think the right way to think of this is to look at the bigger picture and how the data, taxonomy, and infrastructure are related. That's what we need in terms of accelerating the green engine to support the recovery.
Perhaps if you could allow me a 10-second intervention. As with any asset class that is just starting, it is true there is a very fast growth on ESG dedicated assets, but as a whole, the asset class is still quite small. Take, for example, the European sovereign bond market. There are several large economies that have issued green bonds lately. With Italy, they have amassed a huge interest from the investor community. And yet, the whole stock of green sovereign bonds in the euro area amounts for less than 1% than the entire outstanding amount.
Thank you. We're going to take one more question because we're running out of time here from Masaki Kondo, GG Press on Webex, please.
Thank you very much for taking my question. My question is about the failure of Archegos capital management recently, and the related losses by big banks like Credit Suisse and Nomura. I'm wondering how much we should be worried about this incident. And do you think this is sort of isolated event, or there would be more to come, like huge, big losses? And what is the implication for the global financial stability for this event? Thank you very much.
Yeah, thank you for this question. And we've all followed the headlines this morning about further losses in some institutions. So the question is whether it's the canary in the coal mine that we are seeing such losses. Our assessment for the moment is that this incident is not systemic, that it remains manageable by financial institutions, and that it is an incident that is specific to one particular fund. But having said that, it does illustrate that many of the major bank dealers have common exposures to their clients, and that counterparty risk management and the prudential regulation in the segment continues to be a priority.
Yeah, so maybe I can add one point. So the report called for a pressing need to act to avoid a legacy and preempt a legacy of vulnerabilities. And vulnerabilities is a good example of financial vulnerabilities, whether this is financial leverage that has been used to enhance and boost returns, or whether it is the interconnectedness between the non-bank financial institution as well as the banking sector. So because there are possible lags between activation and the impact of macroprudential policy tool, we call for policymakers to take early action. In particular, they should tighten selected macroprudential policy tool to tackle pocket of vulnerabilities, at the same time avoiding a broad tightening of financial conditions. That's not what we need for the recovery. In addition to that, because in some cases such tools are not available, for example, in the non-bank financial intermediation sector, we argue that policymakers should very quickly develop such tool. And also, finally, given the challenges in terms of designing and implementing tools within the existing macroprudential policy framework, policymakers should consider whether there's a need to raise buffers elsewhere in the system so that the system is more resilient and able to absorb losses. Now, what we have seen here is that, of course, banks have higher capital, higher liquidity. So given what we know at this point, they probably be able to absorb some of these losses. But it still raised the question of the interconnection between stretch valuation, elevated financial vulnerability, particularly when they are particularly pernicious when they occur in the non-bank financial institution with links back to the banking sector.
Thank you very much. We come to the end of our press briefing here. Thank you to everyone who followed us today. Thank you to Tobias, to Fabio, and to Evan. And we invite you to follow us tomorrow for the release of the Fiscal Monitor. Thank you, everyone.
Thank you very much.